In this video, we're comparing 3 of the biggest S&P 500 ETFs in an epic showdown. Which is better? Well, stick around because I will declare a winner, or two. But first, what's an ETF? What's the S&P 500? And why would we want to invest in an S&P 500 ETF in the first place? ETFs are similar in many ways to mutual funds, except that ETFs trade throughout the day on stock exchanges as if they were individual stocks. Mutual funds, on the other hand, are bought and sold based on their price at the end of the day. You can't get in and out of mutual funds throughout the trading day like you can with ETFs or individual stocks. ETFs hold a basket of assets such as stocks, bonds, or commodities. The ETF ownership is divided up into shares, which are held by shareholders. Most ETFs are also index funds. They hold the same proportion of assets as a certain stock market index or bond market index. And because they track an index, they're considered passively managed. That is, there's no fund manager actively picking which stock should be in the ETF. The ETFs we're comparing in this video proportionally hold the stocks of the S&P 500. The S&P 500 is a stock market index tracking the stock performance of 500 large companies listed on stock exchanges in the United States, also referred to as large cap stocks. With the S&P 500, we're talking about the biggest US companies. But check this out. Although it's called the S&P 500, the index actually contains 503 stocks because it includes 2 share classes of a stock from 3 of its component companies. An example of this would be Alphabet stock, which has 2 classes of stock, one with non-voting rights and the other with voting rights. And one of those tickers is GOOG, G-O-O-G, and the other is GOOGL, G-O-O-G-L. So each ETF contains right around 503 stocks to match the index. And the index is market cap weighted, which means it holds more shares of the biggest companies and less shares of the less big companies. The S&P 500 is a popular index because its performance replicates that of the entire US market. It's kind of shorthand for the market. Want to know how the market's doing today? Check the S&P 500. So S&P 500 ETFs replicate the S&P 500 index, but in a smaller package. This is amazing and very convenient because we can purchase 500 of the largest US companies at one time simply by buying one share of an S&P 500 ETF. It's no wonder that an S&P 500 fund is the stock fund Warren Buffett recommends to most investors. In his 2016 letter to investors, Warren Buffett reiterated his investment advice for most people: a low-cost S&P 500 index fund. In the same letter, he reminded us that he issued a bet to investment professionals that they couldn't beat the S&P 500 over 10 years, from 2008 to 2018. No one did, by the way. But the Vanguard S&P 500 fund, VOO, was the specific fund that Buffett used as his contender in this challenge. I'll leave a link to his letter in the video description. So we've established that the S&P 500 and ETFs are good, but which specific S&P 500 ETFs are the best? Which should we invest our hard-earned money into? We're going to look at 3 of the biggest and most popular S&P 500 ETFs. These have the following ticker symbols: SPY, VOO, and IVV. Each of these funds is operated by a different large financial institution. SPY, whose official name is the SPDR S&P 500 Trust ETF, is operated by State Street. VOO, the Vanguard S&P 500 ETF, is operated by Vanguard. And IVV, the iShares Core S&P 500 ETF, is operated by BlackRock. We'll look at 4 factors for each fund and then come to a conclusion about them. We're going to look at fees, performance, dividend yield, and liquidity. For our comparison, epic showdown, we're going to start with fees. When we're comparing ETFs that are so similar and track the index, one key differentiator would be the fees they charge. ETFs typically have a built-in fee called an expense ratio. These fees for index fund ETFs are usually quite low, but they're still an important consideration because even small fees can add up to big bucks when compounded over time. SPY's expense ratio is 0.0945%. We could round it down to 0.09%, but we're not going to because these fees matter. Every little bit adds drag on the return. VOO's expense ratio is 0.03%, and IVV's expense ratio is also 0.03%. These percentages seem small, but look at it like this. SPY's expense ratio is more than 3 times that of VOO and IVV. So is there something special about SPY that would make it worth paying 3 times the fee to hold it? Maybe SPY makes up for it in performance. Well, let's find out. I ran each fund through Portfolio Visualizer as a separate portfolio to compare their performance over the last 12 years. And 12 years is the longest time period available for all 3 funds. Well, anyway, here are the results. First, if we look at this nice chart here that actually does show all 3 funds. There's 3 separate lines with 3 separate colors, but it's hard to tell because their performance is virtually identical. And if we look at the numbers in the table up above here, you can see with an initial starting balance for each of these 3 funds of $10,000 what their final balance would be, and their compound annual growth rate, which is also very, very similar. For SPY, the compound annual growth rate is 11.40%. For Vanguard's VOO, it's 11.45, and for the iShares IVV fund, it is also 11.45. So 11.45, 11.45, but SPY is lagging with only 11.40. Why is that? What happened to that 0.05%? Well, I think it can be explained by the fees that SPY charges versus the fees charged by VOO and IVV. Their performance is practically identical, but we have to give the nod here to VOO and IVV. So far, it's not looking good for SPY, but let's check out dividend yield. We should expect the yield for these ETFs to be very similar to each other. SPY's yield is 1.63%, VOO's yield is 1.65%, and IVV's yield is 1.61%. So we're going to have to give this one to VOO, although it's almost insignificant because it's such a small difference, and these yields fluctuate over time as the prices change. So it's just a snapshot in time that we're looking at here, but VOO wins for dividend yield. Next, let's look at liquidity. That is, how much are these stocks traded and how popular are they? Well, make no mistake, all these ETFs are very popular and they are going to be very liquid, so it's not much of a concern, especially for buy and hold investors. If an ETF was not very liquid, it could be difficult to get in and out of it, and there might be more of a spread between the bid and ask, which could result in overpaying on order entry. Again, this is not really a concern with these ETFs, but we're going to compare their liquidity anyway by looking at assets under management and average trading volume over the past 30 days. SPY's assets under management is $365 billion, and the 30-day trading volume is 98.73 million shares. VOO's assets under management is $259 billion, and the 30-day trading volume is 5.15 million shares. For IVV, the assets under management is $287 billion, and the trading volume is 5.47 million shares. So in looking at these, a couple of things stand out. First of all, I'm surprised that VOO and IVV are just so close as far as assets under management and trading volume for that matter. And I'm also surprised that IVV is bigger than VOO. Of course, I did know going into this that SPY had more assets under management and much more trading volume. So after all this, which of these 3 ETFs is better? With such small differences overall, and considering the wisdom of investing in the S&P 500, none of these are bad choices. In fact, they're all very good choices in my opinion. But after doing this comparison, I do have some preferences. If you're a trader and you want to sell in and out of the S&P 500 by timing the market, or if you want to trade options on the S&P 500 like I dabble with, the choice is clear. SPY is your winner. And the reason is that liquidity. Being able to get in and out of the trade quickly, and if you're trading options, having a lot of options being traded and having lots of different expiration dates to trade options with, it just makes SPY the clear choice for traders. But for buy and hold investors, it's a closer call between VOO and IVV. Again, both are great options. And if you only have access to one or the other, or if you're already invested in one or the other, I wouldn't sweat it at all. But if I had to choose, I'd give the nod to VOO, with its slightly higher dividend yield, and not to mention the Warren Buffett seal of approval. And if you need another tiebreaker, how about turnover ratio? The turnover ratio is the percentage of a fund's holding that have been replaced in a given year. Why does this matter? Well, funds with high turnover ratios might incur more costs, like trading fees and commissions, and they might generate short-term capital gains, which are taxable at an investor's ordinary income rate. Now, VOO's turnover ratio is 2% compared to 3% for IVV. So yet another small reason to declare VOO the winner. That's what I have for you in this video. I hope you got some value out of it. If so, give it a like and consider subscribing to my channel for more videos on saving, investing, and early retirement. Thanks for watching.